Welcome to my YouTube channel, where I'm going to explain to you what in the hell is going on with the stock market. Nobody seems to know. Well, I do, and I'm going to explain to you. If you remember, we had our final crash here in February. We dropped 42%. Then the market rallied back up, and here we are today. Still can't make new highs. We lost $31 trillion in equity, was wiped out. On the way back up, we only recaptured $8.5 trillion as there's no buyers because people aren't interested in buying because stocks are overpriced by 140%. They also know something else. Gold, remember, is a great indicator. When you have gold, when you have gold going up, like right here, if you remember, we had this. I told you was the end of the rally. I said from 2008 to this September 2018, that was the end of the bear market rally. It was over. And I said it was going to crash, and it did. It went down. And when it went down, gold goes up. Same thing here. When it went down, the market's going down, people go to gold. So investors switch out of stocks and go into gold. Now, the same thing here. Gold is going up. Well, how come the stock market's going up? It shouldn't be. It should be coming down. But there's an election going on, and Trump needs to have the stock market go up. So what he did, he made sure they injected $700 billion into stocks. Sound familiar? That's the same thing they did right here, like this. If you remember, 2008, they printed $1 trillion, injected into the stock market, gave it to the banks. Banks went out and bought all these stocks. And the bank stocks bought their own stocks because you need bank stocks leading to rally the market. Market went up 80%. My God. By November 2010, the market was ready to crash again. So they turned around, printed $650 billion, injected it. They bought stock. Market moved up 33%. September 2011, market was ready to crash again. They injected $400 billion. Market went up 28%. By 2012, market was ready to crash again. They injected another trillion. Market went up about 25%. So that's over, 135, 160 point rally in that short period of time. So let's go back and take a look at where it's actually going on today. We can learn from that. So again, what makes stocks go up? Well, I just showed you. You can do financial engineering, which we did from 2008 to 2012, where the market went up, I think, 125%, and there was no earnings, no profits, no economic growth. What grows the economy? Remember, the economy is separate from the stock market. The economy is earnings of a company, their profits. When earnings go up, profits go up, and people love to buy stock of these kind of companies that have good earnings, good profits. Well, how does their earnings and profits go up? Well, because they produce. If the economy is really good, they produce more. So that's called GDP, economic GDP. So if you take economic GDP, the amount of goods we produce every month, every quarter, and you take the earnings and profits from selling those goods, combine that, that's called the economy. The economy is separate from the stock market. But we've been lied to in the last many years. They're telling us the economy is the stock market. They're one and the same. No, they're not. The stock market is not earnings, profits, economic growth. The stock market is if you have a company and it's very profitable and you want to buy shares in that company, you go to the stock market to buy the shares. All the stock market, the stocks go up, it just means that investors are pleased with their investment. But as a result of earnings and economic growth, that's why the stock market goes up. Because of earnings and economic growth, you go buy shares of those companies that the earnings are growing and they're producing. So it reflects how happy they are with their investment. But the economy is the economy. Stock market's the stock market. So let's go back, and as I said, if you go back from 2008 to 2012, the market went up 126%, and it went up 126% by injecting $3 trillion, giving the money to the banks to go out and buy their own stocks and some other stocks to push the market up artificially from this point to this point here. Okay? Well, they thought by that end, by 2000, they were only going to do it for 1 year. And they thought by the end of that 1 year, the economy would be growing again. Earnings would be going up with companies. People would be spending money again. And remember, it's the spending that grows the economy. Okay, you got to have spending. If people aren't spending, the economy doesn't increase. It doesn't expand. So at the end of 2012, there's still no spending. Because remember why? Because people got wiped out. About $10 trillion in equity. They lost that in the stock market. They lost money in their home. And so all that equity is gone. 8 million people are out of work. 13 million homes are under foreclosure. So that 2008 period, 2012, where they injected all that money to move it up 26%, they thought by then earnings would be improving and the economy would be growing and then we'd be on our way again. Didn't happen. So they decided, well, how are we going to get the stock market to go up if we don't have economic growth and we don't have profitable companies? Well, we'll do it with the old-fashioned way. We'll cheat. What used to be a felony, quantitative easing. What they simply do is if a company goes and has, let's say a company has their shares are trading at $10 a share. And let's say they have outstanding shares, 30 million shares. Outstanding that people buy and sell, trade all the time, right? And their earnings growth, okay, is at 10%. So at the end of the quarter, before a crash in 2008, this company here, right before the crash, had earnings of 10%. He spread the 10% earning over 30 million shares. That gave his stock value $10. Well, of course, after the crash, by the time 2012 came, they thought, hey, the company would be back doing terrific again. Well, they weren't. What happened? At the end of all this injection of capital, they found out the earnings dropped from 10, the earnings dropped down to 5. So that means if they spread it over 30 million shares, they'd be losing. The stock went from 10 to be at $5. That means the stock market would continue its crash on the way down, break through that low of 2008 and keep going down. Well, they had to do something. So they decided to print the money, and the CEOs, instead of taking that money and investing in their company, new equipment and so forth, and productivity and all that, they said, don't do that. Take the money and reduce the number of shares you have. So now that their earnings were dropped from 10 to 5%, all they had to do is buy their own shares. So they dropped their own shares from 30 million down to 20 million. That's called stock buyback. It's really just a reduction of shares. Now with earnings of 5%, they could spread earnings of 5% over 20 million shares. Instead of stock going down $5, it's going up $5. So now the stock's at 15. Next quarter came. Earnings were even worse. Went from 5% to earnings, went down to 4. Well, if they spread 4 over 20, guess what? Stock was going to go down. So they reduced their shares again. Went down to 15 million. So this is what they've been doing for 12 years. They keep printing money, giving to the company CEO, and he goes in and he keeps on buying down the amount of shares. He didn't need profits, and his stock kept soaring, going up and up and up as his earnings or profits kept going down. It's called prosperity without profits. This used to be a felony. So all they focused on was get the Federal Reserve to loan them money to keep reducing the amount of shares they have, to keep pushing up their fake stock price. They didn't have to have profits. And that's what drove the stock market all the way up. But there was a problem when we reached right here. When we reached September of 2018, that's when I said, this is it. I made the announcements. Everybody mark this down. This is the last day. The crash is here. And I was right. So what happened was, that's when we had the market drop 20%. So this whole rally, how'd they get this rally to go up? I just told you. They keep funneling money to CEOs to keep dropping the amount of shares they had outstanding to boost their stock price up. So every time their profits went down, they reduced their amount of shares they had outstanding, profits go up. It's all phony. It's called, again, prosperity without profits. But the problem was when they got to 2018, the amount of debt the corporations were carrying was humongous. Their debt went through the sky. It went up to almost $16 trillion from like $5 trillion. They couldn't borrow anymore. They're in deep trouble right here. They couldn't borrow anymore. They could, but these companies now are in deep, deep trouble because as they were borrowing the money from the Federal Reserve, they also were borrowing money on the open market, and that money was due, meaning they were selling bonds to put cash on their balance sheet to operate. But those bonds come due. You got to pay back the lender. And at that point in September 2018 or January 2018, bonds were all due. Corporations had no money to pay it back. So, and now the banks started to collapse. Why? Because a lot of the loans, remember, the Fed printed the money, gave it to the banks lent it to the companies. Now the companies are in trouble. The banks are in trouble. That means because if the company's in trouble, they can't pay back the loan, the bank's in trouble. So think about it. That's the big problem. That's what happened. That's why the market went down. Because at that point, the banks were frozen. Because of all of this borrowing of money to do all this reduction of stock prices right here, or outstanding shares, they had so much debt, and they had all this debt coming due, they couldn't pay it back. They're in trouble. So the banks who funded these companies, they're in trouble. So in 2019, overnight, remember, every morning, next morning, your bank has to have enough money where if everybody wanted their money back, they could get it back. Well, that's not what was the case. The biggest banks were in deep trouble. In 2008, remember what happened back here, same thing. And the banks froze up. They couldn't loan to anybody. So in September 2018, the same thing happens. But what they did is quickly started to print money, the Federal Reserve called Robo, and they would loan money to the banks. Actually, what it was like is a pawn shop for the banks. The banks would sell them mortgages, sell whatever they could sell them to raise capital to keep operating. So the next morning they opened up, they had enough money, okay, to meet everybody. If everybody came in and wanted their money back. So that's where it started. Then what happened is the election. So now they're saying, okay, what are we going to do to push the market up again? We'll do the same. What we'll do is we'll start coming in and we'll start printing money, the Federal Reserve. And what we'll do is we'll start buying, we'll fund the banks every night. We'll give the banks $215 billion a night, a month. So they won't freeze up. And we'll also print another $750 billion and push the stock market up. And we'll print another $608 billion and keep buying all the debt these corporations had. And that's how they started to push the market up. All fake. But something was happening. Gold, remember what happens with gold? When markets drop, golds go up. Why? Because when the stock market senses, investors sense something's wrong, they go to gold. So you usually see the market crash and gold goes up. When we had this big crash here, when the market went down 42%, right? Same thing. We had gold going up. But then they started this rally again at the end of March, the one we're in right now, right? And they pushed the market up. But gold was going up. Wait a minute. The market's supposed to come down like it did here. Well, they're decided to hold the market up. They're just going to hold it up. And how are they going to do that? Again, continue with the same $700 billion, $215 billion, $608 million, and that's what they did. And here we are today. They propped it up. And they propped it up right there. And you got the $700 million still going on, the $215 million still going on, and $608 million an hour going on, propping up the stock market. So this market's going to have one hell of a crash. If it wasn't for the $608 million every hour buying the corporate debt, we would have already gone down and tested this low. And by now we'd be on our way all the way back down. Let me tell you where we're going to go. When this market crashes, we're going to go all the way back down. We may not get down to the 2008 low, but we're definitely going to get to the 2012 low right here. So the market's going to drop from where we are now all the way down to where we were in 2012, right there. So that's why they're holding the market up right here. They're doing everything they can to prop the market up, to keep it holding right here. And that's where we are. Now take a look at gold, and I'll prove it to you. Gold always tells you the truth. Watch this. So if you go and you take a look, at gold, let me move this out of here. If you go and we take a look at gold, and let's take a look. And by the way, remember they said we had the best quarter ever, second quarter in a decade? They're lying. Here's the second quarter. Stock market was going up. Remember I showed you how the stock market's going up right here? but gold's going up, telling us that's fake. Look how the economy's going down. Look how the economy's sinking. And even worse, if you go back and you take a look, go back to this point in time, as the market was rallying. Remember, I told you from 2008 to 2012, they're putting all that money in, and the market rallied 126%. They injected $3 trillion, but look where the economy was. The economy's going down. So, and then the economy again went down, and they lied to us on this last quarter, where they said this last quarter was the best quarter, right? And of course, that's a lie. The same thing's happening. So as the market right here from 2012 went up 50%, guess what? The economy was going down 25%. This last quarter, as the market was going up, right? The market was going up, I think it was 42%. The economy dropped 13%. All lies. So the economy's going down, but they convinced everybody that the economy is now the stock market. That's how they get away with it. When they talk about the stock market, they call it the economy. So people won't look at earnings growth or economic growth or earnings or profits. So people hear it's on fire. They always say the economy's on fire, and they point to the stock market. Well, it's over. So what we have to do now is see how long can they hold the market to this point, where again it's really a mess, because when you look at the market overall, okay, again, when you take a look right here, we're holding it right here. Look at the mess we have right in here. So this is going to be interesting. So again, going back to, I just want to show you gold for a moment and show you how gold correlates. If you go and you look at, let's go back to right here in July. Okay, if you go back and look at our market, when the market was going up here, right? We started at March, that quarter, okay? See how gold was going up? That means the market should have been coming down. And also, if you remember when we had that crash right back here, okay? Crash was going down. Look what gold was doing. Gold was going up. Gold was going up. So again, if you just look at gold, it tells you they're lying. So we know right now gold is going up and the market's going up, and that's wrong. That means a crash is coming. When this gold went up, the market came down. When we went all the way back here to 2018, this is the official end of the 2008 to 2018 stock market rally. Remember, gold was going up, stock market went down. Gold was going up, stock market went down. Gold's going up, and guess what? The stock market's going up. The only reason it's being induced, okay, by the 200 billion, 700 billion, and 608 billion an hour. That's it. So if anybody thinks that this market is the best market ever, it's one big lie. So that's why I joined my gang, so that every time the market gets ready to crash, you're finally on the right side. Get out of your long positions and go short. Remember, the markets go down 10 times faster than they go up, because on the way up, they're interrupted by profit taking. On the way down, it's all panic selling. But people never sell when the market sells short. They don't sell short. When the market crashes, they don't sell it short. They're scared to. They've been told they're going to lose all their money. They've been lied to. Instead, what happens? People turn around and they start buying. Instead, what they do is they just stay and they buy even more shares on the way down. They call it cost averaging down. How many times did you want to get out of the market? They told you to cost average down. Terrible. So that's the end of it. That's where we stand. And so again, if the market drops right here, right through this low right here of the S&P, keep your eye on it. Drops below 300, below 290, 296 right there. Make sure you're a gang member, and you're going to catch the market as it drops. And it's going to drop it's going to drop all the way down to where it was in 2012. Just like we caught this drop, we'll catch that drop too. Join my gang. 10 days, it's free. You'll see it works. See you on the charts.